Second quarter corporate earnings are rolling in, but it's becoming increasingly clear that those reports aren't the only things on traders' minds. Negative economic news and the threat of a double-dip recession has the ability to undermine any earnings-backed rally that we may see. That negative economic news isn't just coming from here in the United States. There's still a real possibility of contagion from the sovereign debt crisis that reared its head in Greece this summer. Spain, Portugal, Ireland, and even the United Kingdom are at risk. So why is this important? Because sovereign debt crisis quickly becomes currency crises. That means investors could flee from the euro and even the pound into safer currencies like the US dollar. There is some good news for European investors. Stress tests showed that 92% of European banks would be able to absorb the continued economic weakness and the resulting defaults on credit, auto loans, and mortgages. And the 7 banks that failed the stress test only need to raise $4.5 billion. Compare that to the $74 billion that U.S. banks were forced to raise after similar stress tests here in the United States. A bull market in the U.S. last March followed closely on the heels of those tests. So if that pattern holds, we could see a nice jump in Europe. But on the other side of the coin, such positive results are leading many investors to wonder about the credibility of the European stress tests. Obviously, this makes for uncertain times, but irrespective of global events, there is value out there. And if you focus on longer-term investments, there are great companies that know how to manage through uncertain times and hedge risks to their businesses. Some of those stock prices follow general markets, so they're currently undervalued. But finding those companies is the tricky part, and it takes careful research and proper analysis. And that's exactly what we do for you here at Weiss Research. That's it for me. Thanks for watching.